We always hear about, you know, conquering the stock market requires like ice in your veins, right?
Oh, yeah.
Vulcan-esque detachment from your emotions. Got to like Spock,
Yeah.
and just an absolute like encyclopedic knowledge of every financial ratio and
Yeah.
every, PE ratio and all that stuff. But um, what if? Like, what if that's not the real secret?
Right.
Like, what if the ultra wealthy, the people who are really crushing it in the markets, what if they're not relying purely on that, like cold hard analysis, you know?
Yeah, I mean, that's a really interesting point. It kind of flies in the face of what we're always told, right? Like Wall Street's supposed to be this purely rational, numbers game. But I think there's something else going on there.
Yeah.
Something more human.
Yeah, it's almost like they're using that human element to their advantage, right? So
Absolutely.
it's not just about understanding the numbers, it's about understanding the people.
The psychology, yeah.
Yeah, the psychology and the biases and all that. So that's really what we're going to deep dive into today, right?
Exactly. Yeah.
Like how the ultra wealthy are really using this thing called behavioral finance.
Mhm.
How our psychology affects our decisions when it comes to money.
Right.
How they're using that to get this like unfair advantage in the markets.
And the great thing is this isn't some like exclusive club for billionaires, right?
Right.
Like anyone can learn this stuff. Anyone can use these same principles
Yeah.
to make smarter decisions,
Yeah.
whether you're a seasoned investor or just starting out.
That's right. And to really dig into this, we've gone deep, right? We've been reading articles, research papers, watching all sorts of, videos of financial experts on YouTube just to find the patterns
Exactly.
and the common threads and what these ultra successful investors are doing when it comes to this psychology of money, right?
Right. And our goal today is to distill all of that down into something actionable.
Yeah.
Something that anyone listening can actually use to improve their own investing right away.
Okay, so let's jump right in. And I think a great place to start is this whole idea of overconfidence, right?
Hmm?
It might seem kind of basic, but
Yeah, it's huge though,
it's huge. Yeah.
especially when you're talking about investing because, fortunes can be made and lost so quickly.
Yeah, and you think about like in that world where things are moving so fast, it's so easy to get caught up in it and
Mhm.
think that you've got it all figured out.
Right.
But there's actually this study by Morningstar that showed that the people who traded the most
Oh, wow.
actually had the worst returns.
That's counterintuitive.
Yeah, it's kind of crazy, right?
Yeah.
And they called this the illusion of control.
Ah, okay.
So the more you're in there like tinkering and, moving things around,
Right.
the more you might feel like you're in control, but actually you're probably just messing things up.
Yeah, you're just shooting yourself in the
Mhm.
potentially.
Yeah, and this reminded me of something that Tay Kim talked about in one of his videos about the concept of enough.
Okay.
He was saying that a lot of the really wealthy people, they get to a point where they're like, okay, I have enough.
Yeah.
And they're not constantly chasing the next big thing.
Yeah.
Because that chasing, that can lead to this like overconfidence, right? It's like,
Yeah.
oh, I just got to keep getting more and more and more.
It's never enough, right?
Yeah. Yeah. And that's when you start making those like really risky decisions that can blow up in your face.
And that's a great point. I think that ties in really well with the idea of like wealth preservation versus wealth creation, right?
Right.
Like getting rich is one thing, but staying rich is a whole different ballgame.
Yeah.
And Tay Kim uses this great example of Mike Tyson, who obviously earned a fortune but ended up losing it all.
Right.
And the point there is that staying wealthy requires humility.
Yeah. Yeah.
It requires this healthy fear of loss,
Yeah. You got to almost respect the downside.
Exactly.
Right. So
Yeah.
the takeaway here is really to be aware of that tendency to get overconfident.
Yeah, be self-aware.
Yeah. Be self-aware and know when to step back and really define for yourself what enough means.
Yeah, because if you don't have that clear definition, it's easy to get caught up in that rat race.
Right. And just keep chasing and chasing and chasing. All right. So another really interesting bias that we've been looking at and that the ultra wealthy seem to be really good at managing is selective memory.
Oh, yeah, this is a classic one, right?
Yeah. So we all tend to do this, right?
Absolutely.
We remember our wins.
Yeah, we highlight those.
Yeah. We talk about those.
But the losses, we kind of sweep those under the rug.
Yeah. It's like, oh, yeah, that didn't happen.
Exactly.
And this can be really dangerous when it comes to investing because if you're not learning from your mistakes.
You're doomed to repeat them, right?
Yeah, exactly. And this ties into another bias called confirmation bias.
Oh, right. Yeah.
And we saw this mentioned in Investopedia and that cognitive bias and market forecast.pdf document.
Yeah, that was a dense one.
Yeah, it was, but really interesting. And it basically means that we tend to look for information that confirms what we already believe.
Right. So we're filtering out anything that contradicts our worldview.
Exactly. And the team over at New Harbor Financial, they had this great example of how this can play out in the real world.
Oh, yeah. What was that?
So they were talking about how sometimes people's political beliefs can actually influence their investment decisions.
Interesting.
Yeah. So like if someone has a strong belief about, a particular industry, let's say renewable energy,
Okay.
they might be more likely to invest in that industry even if the numbers don't really support it.
Right. So they're letting their emotions cloud their judgment.
Exactly. And this is where it can get really tricky because, it's not always easy to separate your personal beliefs from, objective analysis.
No, it's not. It's a constant battle, right?
Yeah. So the key takeaway here is to really be aware of that confirmation bias and to actively seek out different perspectives,
Yeah. Expose yourself to different viewpoints,
even if they make you uncomfortable.
especially if they make you uncomfortable, right? Because that's probably where you're going to learn the most.
Yeah. And another thing that can be really helpful is to keep track of your investment decisions.
Oh, like a journal?
Yeah, kind of like a journal or a log where you write down why you made a particular decision.
Oh.
And then you can go back and revisit those decisions later on and see if you were right or wrong.
Yeah, and analyze your thinking.
Exactly. And this can help you to identify any patterns or biases in your decision making.
That's a great idea.
Yeah, so another concept that we've been digging into is mental accounting.
Okay, this sounds interesting.
Yeah, so this is how we tend to categorize our money in our minds.
Okay.
And it's something that Morningstar talked about, as well as the research in dervisage.pdf and Investopedia.
Okay.
And they all emphasize how this can lead to some really weird and irrational behavior.
Like what?
So for example, let's say you get a tax refund.
Okay.
You might be more likely to take a big risk with that money.
Really?
Yeah, like invest it in something really speculative.
It feels like free money.
Yeah,
Yeah.
exactly. It feels like found money, so you're not as worried about losing it.
Right.
But then on the other hand, you might have money that you've been saving really diligently.
Yeah.
From your paycheck.
Yeah. Hard-earned money.
Yeah.
Yeah.
And you're way more cautious with that money, even though
For all the same.
it's all the same, right?
Yeah.
It's all just money. But in our minds, we've created these different categories.
That's so strange when you think about it.
Yeah, it is. And this is where the framing effect comes in.
Okay, framing effect. What's that?
So this is something that Morningstar also talked about. And it basically means that the way something is presented to us can really influence our decisions.
Like how it's worded or...
Yeah, or like what it's compared to, even if those comparisons are totally irrelevant.
Oh, okay, so it's like marketing.
Yeah, kind of like marketing.
Interesting.
So the takeaway here is to really be aware of these mental categories that you're creating in your head and to remember that money is money.
Right, it's fungible.
Yeah, it's fungible. And every investment decision should be based on its own merits, not on where the money came from or how you've mentally categorized it.
Yeah, that makes sense.
All right, so let's talk about another big one, loss aversion.
Okay, yeah, this is a powerful one.
It's a big one.
Yeah. And we saw this mentioned by Magellan Financial Group in that book, Mind Over Money, how behavioral finance shapes investment decisions, and also in dervisage.pdf.
Okay.
And basically, loss aversion means that we feel the pain of a loss much more strongly
Then the pleasure of a gain.
than the pleasure of an equivalent gain.
Yeah. Yeah, I can definitely relate to that.
Yeah, me too. It's like that saying, right, losses loom larger than gains.
Exactly. And Magellan Financial Group pointed out how this can lead to people holding on to losing stocks for way too long
Oh, yeah.
because they just can't stomach the thought of selling at a loss.
Even if it means losing even more money in the long run.
Exactly.
Yeah, it's like that sunk cost fallacy.
Yeah, you're throwing good money after bad.
And this is closely related to another bias called regret aversion.
Regret aversion. Okay, I haven't heard of this one.
Yeah, this one was mentioned by New Harbor Financial and dervisage.pdf.
Okay.
And it basically means that we're so afraid of making a bad decision
Mm-hmm.
that we either do nothing.
We just freeze up. Yeah. Or we just follow the crowd.
Safety in numbers.
Yeah. It's like, well, if everyone else is doing it, it can't be that bad.
Right. Even if it's a bad decision, at least you're not alone.
Exactly. So the key takeaway here is to really understand your own aversion to loss.
Yeah, be honest with yourself about it.
Yeah, and have a clear exit strategy before you even make the investment.
So, like, know your limits.
Yeah, know your limits, know when you're going to sell,
And stick to it,
and stick to it no matter what.
even if it's painful.
Even if it's painful, don't let your emotions get in the way.
Right.
All right, so another bias that can really trip people up is recency bias.
Okay, recency bias. What's that all about?
So this one's all about putting too much emphasis on what's happened recently.
Oh, so like recent performance.
Yeah, exactly. And New Harbor Financial talked about this one.
Okay.
And they said that this can lead people to chase hot stocks.
Oh, yeah, buying what's been going up.
Yeah, like, oh, the stock's been up 20% this year. I got to get in on that.
Right.
Or it can lead people to panic sell after a market downturn.
Yeah, assuming it's the end of the world.
Yeah, because they're only focused on the recent losses.
Right. They're not
Yeah.
looking at the bigger picture.
Yeah, in New Harbor Financial, they had this really interesting analysis of growth stocks versus dividend-paying stocks.
Okay.
And they looked at the period between 2007 and 2025.
Wow, that's a long time.
Yeah, it is. And it showed how those two types of stocks kind of went back and forth in terms of performance.
So what was hot one year wasn't necessarily hot the next.
Exactly. So the takeaway here is that past performance is not a guarantee of future results.
Yeah, that's like the investing disclaimer 101.
Yeah, and don't just extrapolate from recent trends.
Yeah, you got to look beyond the headlines.
Exactly. So,
Yeah.
we talked about Take Cam earlier, and one of the things that really stuck out to me was his emphasis on knowing when enough is enough.
Right.
And how the ultra wealthy seem to really get this.
Yeah, they're not constantly trying to keep up with the Joneses.
Exactly. And they understand the power of long-term compounding.
Yeah, that's where the real magic happens, right?
Yeah. And Take Him, he actually called it the ridiculous power of compounding.
I love that phrase.
Yeah. And he talked about how Warren Buffett built his wealth,
Oh, yeah.
not through like some amazing stock picks or anything like that.
It was just consistency.
Yeah. Consistency over
Just
decades.
letting those returns compound year after year.
Yeah. And that's something that we can all do.
Absolutely. You don't have to be a genius to be a successful investor.
You just got to be patient
Yeah, and disciplined.
and disciplined. Yeah. So the key takeaway here is to focus on building wealth slowly and steadily over time.
Yeah, don't get distracted by the short-term noise.
Yeah. Block out all the distractions.
Tune it out.
All right. So let's talk about the role of financial advisors.
Oh, okay. Yeah, this is a big one.
Yeah, because, we've been talking about all these biases and how they can affect our decisions.
Yeah.
And it can be really hard to overcome these biases on our own.
Yeah, we're not always the best judges of our own behavior.
Yeah, exactly. So this is where a financial advisor can really come in handy.
Yeah, they can be that objective voice of reason.
Exactly. And there's actually research that shows that financial advisors can add a lot of value just by helping their clients manage their emotions.
Really?
Yeah, so the Financial Planning Association, they cited the study from Vanguard called Advisors Alpha.
Okay.
And this study found that a big chunk of an advisor's value comes from behavioral coaching.
Wow, so it's not just about picking stocks.
No, it's about helping people stay on track with their goals.
Keeping them from making those emotional decisions.
Exactly. And there's another study by Del Bar that was also cited by the Financial Planning Association.
Okay.
And this study found that individual investors tend to underperform the market because they trade too much.
Oh, yeah, because they're chasing returns or panicking.
Yeah, exactly. And they end up buying high and selling low.
The classic mistake.
Yeah. So the takeaway here is that if you're struggling with these biases, it might be worth considering working with a financial advisor.
Yeah, they can provide that guidance and support.
Yeah, and to help you stay disciplined. All right, so I think it's really inspiring to look at how these ultra-successful investors approach the markets.
Yeah, they definitely have a different mindset.
Yeah, and one thing that really stands out is their long-term perspective.
Yeah, they're playing the long game.
Exactly.
Yeah.
And we saw a great example of this in Ken Langone's interview with Joe Lonsdale.
Oh, yeah. What did he say?
So Ken Langone, he's a billionaire investor.
Okay.
And he talked about how important it is to be patient and loyal to your investments.
Like buy and hold.
Yeah. And he said that his average holding period for his investments is 42 years.
42 years. Wow.
Yeah, that's like the lifetime.
That's incredible.
And it's a stark contrast to all that rapid trading that we see so much of these days.
Yeah, driven by those biases we were talking about.
Yeah, exactly.
Yeah.
And speaking of long-term investors, we can't forget Warren Buffett.
Right, the OG.
Yeah. And he's famous for saying, wait, then pounce.
I love that quote.
Yeah. It's all about being patient, waiting for the right opportunity, and then taking action.
Don't force.
Yeah, don't force it. And this is something that we can all learn from.
Absolutely. Patience is key in investing.
Yeah. So cultivate that patience. Resist the urge to jump in and out of the market all the time.
Yeah, and focus on building a portfolio of high-quality investments that you can hold for the long haul.
Exactly. All right. So we've talked about a lot of different biases today.
Yeah, it's been a whirlwind tour of the human psyche.
It has, but it's important to remember that even the most successful investors are not immune to these biases.
Yeah, that's right. The Financial Planning Association, they did a study on this.
Oh, yeah.
And they found that even people with a lot of wealth and a high level of financial literacy,
They still make mistakes.
yeah, they still fall prey to those emotional traps.
Yeah, so it's not about being perfect. It's about being aware of these biases and taking steps to mitigate them.
Right. And that same study also found that wealthier individuals are actually more interested in continuing to learn about finance.
Oh, interesting.
Yeah. So it's like they recognize that this is an ongoing process.
Yeah, you're never done learning.
This exactly.
All right, so one last thing that we wanted to touch on is how external factors like political beliefs can influence investment decisions.
Right. This is something that New Harbor Financial brought up.
Yeah, and it's something to be really mindful of because it's easy to let our beliefs cloud our judgment.
Absolutely. We can get caught up in our own echo chambers.
Yeah, so it's important to be objective.
Yeah. Look at the data.
Yeah, and don't let your assumptions drive your investment decisions.
Right.
So to recap some of the key strategies that we talked about today, the ultra-wealthy, they seem to be really good at mitigating overconfidence, counteracting selective memory, managing mental accounting, effectively navigating loss and regret aversion, avoiding recency and extrapolation bias, understanding the power of enough and long-term compounding. And they often work with financial advisors to help them stay on track.
Yeah. And the big takeaway for everyone listening is that simply becoming aware of these biases is the first step towards making better investment decisions.
Absolutely. It's all about shining a light on those hidden psychological forces
Ex-
that are influencing our behavior.
Right.
So here's a final thought for you to consider. Now that you have a deeper understanding of these biases, how will you actively work to counteract them in your own investment journey to build wealth more effectively over the long run?
That's a great question.
Yeah. And maybe this is a good time to take a look back at some of your past investment decisions
Oh, yeah.
and see if you can identify any patterns or biases that might have been at play.
That's a great exercise for anyone.
Yeah, I think it's really eye-opening.
It can be.